Many traders suffer significant losses primarily because they trade without a clear understanding of their position in the market. They often believe that using a strategy involving multiple indicators will guarantee profits, without grasping the overall market structure. Large players in the market, like hedge funds, banks, and institutional investors, consistently analyze various market cycles and adapt their trading strategies accordingly. For traders who understand these cycles, it becomes clear how to navigate and trade in each of them. In the first cycle, you observe a series of strong candles, which clearly indicate an unmistakable trend, either moving up or down. Another key feature of these candles, apart from their long bodies and minimal shadows relative to their main bodies, is their tendency to avoid breaking below the prior candle's low in a bullish trend or surpassing the prior candle's high in a bearish trend. As we approach the end of this cycle, the strength of the trend diminishes considerably, leading to an expectation of more pullbacks. However, this phase still corresponds to the previous dominant impulsive trend, but with reduced momentum. We refer to this phase as a channel, and it should not be confused with other market channel types. Our trading strategy during a spike cycle varies substantially from that in a channel. When we identify the market in a spike phase, our focus remains solely on trading in the spike's direction, without seeking counter-trend entries. When the price action enters a channel phase, we can think about initiating long trades at the lower trend line and, conversely, considering selling positions at the upper trend line. However, it's crucial to prioritize trades aligned with the spike cycle's direction. This is because our goal is to consistently trade in the direction of the prevailing trend, which significantly reduces the levels of risk we are willing to accept. When the price eventually exits the channel, it enters another phase known as a trading range. This transition often coincides with the formation of strong candles, characterized by large bodies and ideally small wicks or tails. During a trading range, our focus shifts to considering short trades at the range's upper boundary and long trades at its lower boundary. This strategy aligns with the classic principle of buy low, sell high. Although it's possible for the price to move directly from a spike to a trading range without going through a channel, it's quite rare for a channel cycle to occur immediately after a trading range. Remember that we don't categorize channels with a slope opposite to their preceding spike as typical channel cycles. Instead, we often refer to them as flags. Upon their completion, we don't anticipate the formation of a trading range. Instead, we expect a breakout above the flag and a continuation of the previous trend. We might also encounter another spike after a channel or trading range, although the more typical sequence involves a spike followed by a channel and then a trading range. It's crucial to emphasize the significance of these sequences when you're making your trading decisions. Misinterpreting these cycles can significantly increase the likelihood of getting stopped out due to taking positions that go against the market's dominant trend. Another crucial point to remember while trading across different market cycles is to consistently consider higher timeframes when trading on lower timeframes. Allow me to illustrate this concept with an example. In this scenario, after a spike in channel formation on a 30-minute time frame, it appears that the price has reached the upper boundary of a trading range that has been tested multiple times. If we base our judgment solely on this time frame and take into account the presence of this strong reversal candlestick pattern, we might consider this as a suitable moment to enter a short position, placing our stop loss above the trading range and setting the take profit near the bottom of the trading range could be a strategic move in this situation. But if we zoom out and consider the higher time frame, we see that in the larger context, we are positioned at the lower end of the trading range. This suggests more favorable buying opportunities in shorter time frames. So despite the initial appeal of a short trade, it's crucial to dismiss any potential short entries and redirect our attention to potential long positions, especially after a confirmed breakout above the trading range. Now you can appreciate how the longer time frames and their cycles influence the shorter time frames and why it's essential to always keep the bigger picture of the chart in mind. By doing this, you significantly increase your chances of winning trades and prevent unnecessary losses. If you recall from earlier in this video, I briefly mentioned that during a spike cycle, we avoid considering any counter-trend trades, even on lower time frames. Here, you can see that the pair has been in a spike cycle for over 10 candles in a 4-hour time frame, but the appearance of a red candle with a small body suggests a decrease in momentum following a rapid move. It could, however, be just a temporary pause, as the market often has enough momentum to continue. These weak candles usually cannot trigger the start of a channel cycle because they lack the strength to initiate the next phase. While this candle appears insignificant on the 4-hour chart, it can be an entire trading range on the 5-minute chart, providing us with exceptional trading opportunities. The crucial aspect to note here is that since we are in a spike cycle, on the higher time frame we focus exclusively on exploring buying opportunities at the bottom of the trading range in a 5-minute chart. We disregard any sell signals generated at the top of the trading range because they go against the prevailing trend in the higher time frame. Also, it's important to note that the upper and lower boundaries of a trading range are typically zones rather than fixed lines. This seemingly straightforward idea can mislead many inexperienced traders, causing them to believe these boundaries are breached. As a result, they might try to enter the market using a breakout strategy, leading to significant losses. In this situation, a valuable tip is to consider higher levels as your ultimate take-profit target when entering a long trade at the bottom of this small trading range. One method to estimate these extended targets is to exit your trades at a distance equivalent to 1 or even 2 times the height of the trading range, extending from the top of the original trading range. As you already know, when the price fluctuates inside a trading range, we have the option to enter buy or sell positions at the bottom and top of the range respectively. However, there are instances when the price only moves a fraction of the trading range's height. It then swiftly changes direction, triggering a stop loss positioned outside the trading range. This becomes particularly important when trading against the dominant trend. In such cases, you shouldn't anticipate the price to reach the opposite end of the trading range entirely. Remember, adopting this approach is not advisable unless you have additional confirmations indicating that the trade is worth the associated risks. When handling such conditions, whether in bullish or bearish scenarios, I review the chart history to identify areas of support and resistance. These areas should be where the price has shown multiple reactions. I then set my take profit level somewhere between these areas. Here's another example from the daily time frame of the gold chart. It illustrates how we can anticipate a failure to reach the boundaries of a trading range and predict the likely direction in which the price will break out of that range. Observing the chart, you can notice the formation of 3 consecutive cycles: spike, channel, and trading range. It's reasonable to anticipate the price reaching the upper boundary of the trading range once more, and then consider potential selling opportunities in that region. But if you look closely, you'll see that the price is consistently forming lower lows and lower highs, a significant indicator of a bear market. Furthermore, the price has repeatedly encountered resistance at this bearish trend line, unable to break through and reach the upper boundary of the trading range. Taking into account all of these signals, when the price approaches this trend line for the 5th time and experiences a rejection with a well-defined pin bar and a bearish candle, it presents an opportunity to enter a short position. We can place our stop loss above the pin bar and set the lower boundary of the extended trading range as our ultimate take-profit target. When we spot a support or resistance area at the bottom or top of a trading range, and we plan to use limit orders for our trade entries around these zones, it's important to consider that placing orders at the proximal line, which is the line closer to the current price action, increases the likelihood of them being triggered. However, this method often leads to less favorable reward-to-risk ratios, while implementing a fixed stop loss above or below the trading range and setting a take-profit level at the opposite end of the range. Conversely, if we position our order at the distal line, which is farther from the current price action, the probability of getting triggered is reduced. However, this approach often results in more favorable reward-to-risk ratios. Also, remember to provide enough space for the price when setting your stop loss. One effective method is to calculate the average length of shadows nearby and subtract that amount from the distal line in a bullish scenario. This approach helps you prevent setting your stop loss too close to the outer boundary of a trading range, reducing the risk of being stopped out before the market moves in your desired direction. We've discussed extensively how to trade within a trading range once we identify its upper and lower boundaries. But what if we aim to profit from the transition between a channel and a trading range, while the trading range is still in its early stages. To execute such trades, our initial step involves speculating on potential locations where a trading range is expected to begin after the price exits a channel. To achieve this, we consider three primary targets. Our first target could be the conclusion of the spike cycle, marked by the closing price of the last candle in this phase. The second target could be the point where the channel begins to take shape. In a bullish trend, this might be located below the channel, while in a bearish trend, it could be above the channel. Lastly, the final target is represented by a small candle that momentarily halts the progression of a spike cycle. These candles typically have small bodies and are situated somewhere in the middle of a spike. In this scenario, given the extended duration of the channel following a strong spike, we might consider the conclusion of the spike cycle as our initial target. After marking this line on our chart, we search for a clear channel breakout. However, I typically refrain from entering the market immediately after a breakout. Rather, I exercise patience and await a pullback either to the trend line or in proximity to the breakout point before considering my next move. However, given that we've already reached our initial target on the 8-hour time frame, it's prudent to switch to a lower time frame, such as 30 minutes. This shift allows us to identify another trading opportunity during a pullback, with an acceptable reward-to-risk ratio. When we switch to the 30-minute time frame, we observe that the price has retraced to the trend line and found support at lower levels. At this point, we keep a close watch on the market, looking for signals indicating a potential price reversal. Finally, after spotting the pin bar and the subsequent green candle, we can enter a long position. To manage our risk, we place our stop loss at the bottom of this fractal and target the upper boundary of the newly formed trading range in the 30-minute time frame as our take profit level. Afterward, with the emergence of strong bearish candles, it's clear that the price has rejected that area. This indicates the establishment of the upper boundary of the trading range in the 8-hour time frame. Now, our attention is directed toward observing the price action to identify the lower boundary of the range for that specific time frame. While we may have no initial knowledge of this location, gradually, as more price action unfolds, we can pinpoint the position of the lower boundary of the trading range. Once it aligns with the upper boundary, we can rely on these levels when the price revisits them in subsequent encounters, allowing us to place various buy or sell orders near these extremes in the future. Traders who are familiar with harmonic patterns are likely aware of the ABCD pattern. This pattern consists of 3 legs, with the middle leg moving in the opposite direction of the other 2 legs. In an ABCD pattern, it's common to expect the second impulse wave to match the first one in both length and duration. A similar scenario frequently occurs when the price enters a trading range in the form of a spike and later exits the range in the form of another spike. In fact, in some powerful trends, the price can repeat this process over and over again until it runs out of momentum. It may then find significant support or resistance in the market. Understanding this market behavior allows us to take long and short positions multiple times at the boundaries of these consecutive trading ranges. It also enables us to capture the spike cycles that connect these ranges, although the latter strategy demands more experience. Now that we've briefly discussed the most well-known harmonic structure, let's introduce the concept of combining harmonic patterns with various market cycles to enhance the probability of a successful trade. Based on my experience, I've noticed that many traders hesitate to manually draw harmonic structures on their charts due to various reasons. Therefore, I want to introduce you to a practical indicator that can automatically calculate and draw various harmonic structures on your chart, sparing you the effort of doing the math yourself. To access this tool, click on the Indicators tab and search for HPV2. This is by far the best free indicator I've come across that quickly calculates various harmonic patterns within seconds. In this situation, recognizing that we are at the upper boundary of a trading range and considering only short entries, we can utilize this indicator on our chart. It promptly reveals that a solid harmonic structure is nearing completion, likely around the upper edge of the range. This indicator highlights the potential reversal area in shaded color. It also provides suggested levels for setting stop loss and taking profits. However, these are estimations derived from mathematical algorithms. Understanding the market structure empowers you to place a more precise stop-loss and a broader take-profit, greatly enhancing your reward-to-risk ratio. The boundaries of a trading range can also serve as suitable places to set take-profit levels when the price exits from its neighboring ranges. In this example, you can observe that whenever the price exits a trading range, it tends to reach the outer boundary of its preceding range. This presents an ideal target for breakout traders. Moreover, some of these boundaries could become perfect flip zones in the future. This means that when they are breached, they transition from acting as resistance to functioning as support. In the opening segment of this video, we discussed the concept of extending a trading range and how it can provide us with legitimate targets for our trades. We can employ a technique similar to the one we discussed for trading ranges in the context of channels. However, it's essential to keep in mind that this method is particularly suitable for channels shaped like stairs. Please bear in mind that these are typical price action structures referred to as channels, and they may not necessarily represent the channel cycle we extensively discussed earlier. When the price exits these stair-like bullish or bearish trends, we can extend the channel lines to reach a take-profit level for the trades we've initiated using breakout strategies. Extended lines like these are occasionally employed to identify a potential trend reversal, particularly when the price nears them, forming a reversal pattern. For instance, in this scenario, the price approaches the fourth extension of the upper channel line while forming a head and shoulders pattern, which is followed by a market downturn. And here, as the price approaches this line and develops a three-push pattern, the market transitions into a bullish trend. Most traders perceive pullbacks as retracements from a broken trend line or static support or resistance. While this approach is widely accepted, I'd like to introduce you to another perspective at the candle level. This concept is relatively straightforward. If a candle's high surpasses the high of its previous bar, it's considered a pullback to the upside. Conversely, if a candle's low falls below the low of its preceding one, it's considered a pullback to the downside. This concept serves as the cornerstone of trading range formation. As long as this behavior persists, the trading range will remain in effect. Sometimes we observe strong candles that exceed the previous candle on both ends. Usually in such situations, we can anticipate an extended consolidation phase and explore additional buying and selling opportunities at the boundaries of the trading range, particularly on lower time frames. Here, you can observe the Bitcoin chart over the daily time frame following a massive sell-off. Alternating pullbacks, both up and down, led the price into an extended consolidation period. This continued until one-sided pullbacks to the upside became evident, signaling the possible end of the consolidation phase even before breaking the upper boundary of the trading range. When setting buy or sell limit orders at the lower or upper boundaries of a trading range, you can place your stop loss at a distance equivalent to 50% of the height of the trading range. This strategy is beneficial even when you want to trade after one side of the trading range is breached and you don't want to wait for a pullback, because you believe that the market momentum is exceptionally high, making it unlikely for the price to retrace to the trading range boundaries once again. Traders looking to profit from a trading range keep a keen eye on a specific price pattern. It starts with a series of strong candles on one side, followed swiftly by a similar movement in the opposite direction, all without significant pauses in the market. After this significant shift in sentiment, the market enters a period of consolidation with neither bears nor bulls dominating. It's worth noting that these specific patterns are best identified in higher time frames. To capture trades with favorable reward-to-risk ratios, traders should seek opportunities in lower time frames. By now you should have a good grasp of various market cycles and the ability to differentiate them across different markets. However, there are instances when we observe movements resembling spike cycles within a range. Initially, understanding these patterns may require a substantial amount of effort, but with practice they become easier to detect. Here, you can see that after the spike cycle, the market entered a predictable trading range. However, the price behavior inside this range can be misleading, as some traders may interpret these sharp movements as spikes. But these rapid movements toward the upper or lower sides of the trading range are not spikes. These are just situations where the price is pulled toward these destinations, potentially causing panic for novice traders. Experienced traders, however, can readily identify these behaviors and capitalize on the opportunities they present. In such scenarios, the most effective strategy is to enter a trade when the price rallies toward either side of the trading range and rejects that level with a long shadow, indicating a potential market reversal. For better entries, I usually enter the market during the second opportunity and place my orders somewhere in the middle of that long wick. When it comes to take profit, I typically opt for a shallower distance position near the origin of that swing rather than the other side of the trading range. This approach enhances my chances of success in the trade. Please keep in mind that gaining experience in this type of trading is crucial before engaging in such trades. As mentioned in the previous example, analyzing lower timeframes and identifying reversal patterns can greatly assist you in timing your trades effectively, ensuring excellent reward-to-risk ratios. At times, you may encounter smaller cycles within a larger cycle. For instance, after a significant market decline, we entered a channel, and upon exiting the channel, a big trading range began to develop. But if you pay close attention, you can notice these cycles in lower degrees inside this broad range. After that, you should wait for opportunities where these cycles overlap. For instance, here we find ourselves at both the upper boundary of a large trading range and the smaller one simultaneously. At the same time, we observe a double top pattern, offering an excellent opportunity to go short. Or here, we find ourselves near the bottom of the purple trading range, coinciding with the upper boundary of the green trading range if extended to the right. This presents an opportunity to go long after the price recovers from this fakeout. Then, we can place our take profit at the overlap top of the white and purple trading ranges. I hope this video has provided you with some understanding of the various market cycles. If you're interested in delving deeper into the market context, please let me know in the comments. Thank you for watching.